Let's study EA Capital's market temperature card to get a sense of where we stand in the economic cycle and what should investors expect going forward. In this video, we will first analyze the data in market temperature card, as on October 12, 2023, and then summarize our view in later part of this video. If we study different segments of the markets, in terms of large cap, mid cap and small cap, the Nifty 50, which is the large cap segment, offers an earnings yield of 4.46%, which means a PE ratio of 22.4, seems to be relatively cheaper, compared to mid and small cap. In valuation terms, Nifty 50 is followed by Nifty Small Cap 250 Index with earnings yield of 4.03%. The Nifty Mid Cap 150 Index seems to be most richly valued at current juncture with PE of 24.80. If we further look at bond yields, the India 10-year bond is currently offering an annual yield of 7.3%. The yields have further spiked, compared to last week. The war between Palestine and Israel is having a negative impact on crude oil prices, which took inflationary expectations higher, and along with it global bond yields also went higher. The American Dow Jones Index offers an earnings yield of 4.08%, which is not much lesser than the 4.6% offered by the 10-year US bond. Brent crude price currently stands at $87.3 a barrel, though this is slightly higher than previous week's reading. But as long as this remains below $100 a barrel, Indian economy looks resilient enough to be able to withstand the pressure of higher import bill due to elevated crude oil prices. The volatility index, known as VIX or the fear index, is at a value of 10.62, which is very low and signifies complacency among market participants. We at EA Capital read a low VIX value as a contra-indicator and prefer to remain prepared for higher volatility in near future. TickerTape's Fear Greed Index depicts a value 51.27, which is in the greed zone and closer to fear zone, if its value falls below 50. We take the Fear Greed Index as a contra-indicator and have seen time and again markets showing resistance when it reaches extreme greed zone. Currently we are not yet in extreme greed zone. The BEAR ratio, also known as bond to equity earnings ratio, is at 1.63, which is arrived at by dividing the earnings yield of India 10-year bond at 7.3% by Nifty earnings yield of 4.46%. Though BEAR ratio at 1.63 signifies above average valuations for Indian equities, but with very positive real GDP forecasts for Indian economy, expectations of improved corporate profitability in coming quarters, expectations of interest rates cooling off, inflation remaining under control, it looks unlikely that broader Indian markets will see a deep correction from these levels. The macro indicators also suggest strong on-the-ground activity and growth. GST collections continuously remain very strong with latest number at over 1,62,000 crore rupees for the month of September 2023. Along with GST collection number, both manufacturing and services PMI also signify strong expansion in manufacturing and services sectors. Investors should note that a value of over 50 on the PMI index signifies expansion. Along with this, India's forex reserves stay strong at over $586 billion. Our forex to external debt ratio stands at a very healthy 95.58%. At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel. To summarize, our reading of the data says that the Indian economy is displaying strong fundamentals, and our real GDP growth outlook is positive and India remains fastest growing major economy. The flows into Indian equities remain strong, led by domestic mutual funds. In very near term, we see some downside pressure on Indian equities, as there are geopolitical headwinds, upward pressure on crude oil prices, but from a medium to long-term perspective, strong Indian fundamentals, reasonable valuations and a positive growth outlook of portfolio companies which are part of mutual funds and indices where we are invested, will continue to remain our primary guiding force. Investors must also be aware of risk factors which can dampen the positive sentiment. For Indian equities, these may be a. uneven distribution of monsoon, hence rural economies' growth can remain under pressure. B. The US Fed has signaled possibility of higher interest rates for longer periods. This can potentially take US into recession and impact global growth. C. Higher crude oil prices for longer periods of time can negatively impact India's current account deficit and forex reserves and can pose pressure on Indian currency, thereby negatively impacting foreign flows. D. Markets seem to be pricing in political stability and continuation of reform process after the upcoming elections. Election results otherwise may possibly create upheaval. E. Geopolitical risks and escalation of tensions between Russia and Ukraine, Palestine and Israel. F. In equities, many unforeseen risk factors, which are not mentioned above, may have a significant negative impact in near term, though, in long term, earnings growth of investee companies tends to decide the returns earned by investors. What we would do with our portfolio: we will continue to remain focused on asset allocation in terms of equity and debt. We plan to stay invested in quality Indian equities, primarily through mutual funds, and along with it stay invested in high credit quality debt and high credit quality ultra short-term or liquid funds to have liquidity available to take advantage of the inevitable volatility in equity markets. We also plan to rebalance portfolios at opportune times, from pockets which we feel may be overvalued or if asset allocation between debt and equity deviates too far from our decided percentage allocation between debt and equity. For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you.